Okay. Welcome, everybody. It's Thursday, August 10th. In this lesson, we're going to cover basically a big trade recap. We took two trades today, a short and a long. The long was typed out, the short was traded on voice. It was a failure to go higher. We're going to go over what to look for tomorrow. We have PPI in the morning, and we have the University of Michigan. I believe it's the consumer sentiment at 10 a.m. It's our 10 a.m. news driver. We love trading those. So, without further ado, let's go back into the weekly chart on ESU. We've been calling for this level basically all week. I want to see where this weekly candle closes. We're actually hovering around where we should theoretically bounce from. At this point in time, believe it or not, I'm still bullish. Even though we've had a couple nasty sell offs, I'll explain to you why I'm still bullish. Tomorrow's weekly candle close is the most important thing to me, right? Pay attention to this candle right here on July 3rd. The high of this candle, 44.94, needs to hold itself. We need to close above this level on the weekly time frame to still remain bullish, right? A close below here would completely invalidate our bullish thesis. And when we invalidate that, what I would want to look for is for these lows at 4407 and 4409. They're relatively equal. That will be the next draw on liquidity. After that, we have this low under here at what is that level? 4368, something around there, right? That's another draw on liquidity. Right now, I'm still bullish because of this bullish fair value gap, right? We can bounce out of here, look to trade back into 4,600. I know it's a long shot. We don't really have a lot of earnings. All the high impact news came out today. CPI came in a little bit cooler than expected, but we saw the reaction off that. It was a manipulated run up to sweep the highs. Let's actually get into our trade, and our trade's gonna make more sense. But for right now, on the weekly time frame, I still have to remain bullish. A close below 4494 on the weekly chart completely invalidates my bias and my theory, and we'll need to reassess, right? Let's go into today's first short. Let me get rid of this gap here. Today's first short, and in this lesson, if you guys want to follow along with your own chart, or if you just want to watch, that's completely fine. Today, what we really waited for was two draws on liquidity. We had this 4536 that we broke above, and the higher reaching target was this 4542 level, right? So in the morning, I did miss the long. I took it by myself, I didn't signal it. The first long I took, which you can study from, was this 5 minute gap right here. You saw the CPI print come in, pushed up. We took out a couple highs, pushed back down, swept the lows, completely manipulated blitz on both sides, right? We left this little 5 minute guy right here, and I took a long just targeting this high over here from the CPI print, and I trimmed it there. Missed out on a good chunk of money, which is fine. Just took a quick scalp by myself. Let's get rid of that, and let's get rid of this. That's one to study from. What I'm going to also point to your attention is that these pre-market gaps and levels before 9:30 a.m., open for options, they're valid. They'll work out pretty well. You have to be a little bit more risk adverse when you're trading options in the first 10 to 15 minutes because premiums are a little bit juiced up. IV was very juiced up today. If you guys paid attention to SPY's IV today, it was around 26, 27, 28%. On a normal day for SPY, IV hovers around 19%, 18%. That's the normal IV for SPY. So IV was a little bit elevated. That doesn't mean that premiums didn't pay out. Premiums paid out like crazy. But, when we traded the 450 puts today, these contracts were $1 out the money, maybe $1.50 out the money, but they were still around 63 and 65 cents. Usually contracts that are $1 out the money, $1.50 away, usually they're around 40, 45 cents, maybe high 30s, but around that 40-cent range. So the first trade came from this sweep of this draw right here, this buy side liquidity. If you want to be technical, you can label your chart, make it look really nice. I'm going to be honest with you guys. I don't label my charts like this. It's cool. It's cool for your screenshot on Twitter, whatever the case may be. You don't need to write all that nonsense, right? Really, your chart should just be, okay, we're aiming for these highs, buy side liquidity, sweep of the highs, whatever you want to call it. 4536, 4542. As soon as that 4542 got taken out, we needed to immediately switch our bias to puts. This is a higher time frame sweep of the highs, higher time frame liquidity sweep is what I mean to say. A lot of people will classify this high that got swept, this one right here, as a turtle soup. I don't trade that with options, and there's a reason for that that's very deliberate. With options, you need to be a little bit more precise with your entry. The more it consolidates and chops around, the more you get data cooked, the more your premiums just start consolidating, and it's mental fatigue. So if you're a futures trader, you could have shorted this with your stop a couple points above the high. Aim for this low here, which is a crazy, crazy trade. This is on the 15-minute bigger time frame trade, but that's what a turtle soup is kind of classified as. I personally don't trade that way. I just look for the sweep and the break, right? So let's go into the 1 minute after we swept those highs, and let's focus here. The main gap that I was watching after we had a trend change was this guy right here. And it was so small. It was so small. I really had to like focus my attention to this because I didn't notice it in the beginning. This gap right here was where we took our entry. Our second entry at 65 cents came around 1034. And, we had our TPs well defined. We had our TP right here. I could also do this on a SPY chart, but on ES it is cleaner. TP right here. And we didn't stay in for the full run to like all these lows because we got trailing stopped out. But there's your well thought out trade. We can get rid of this guy right here. Shorted from here, I was risking about 12 to 13 cents on the contract. So bought the second round at 65 cents. The low of those contracts, from what I remember, was 53. I would probably cut it, I'd risk 13 cents because it was a re-entry. I think this was like a 200% trade and God knows how long. We got in 1034, 11 minutes for 200%, which is absolutely ridiculous. It's absolutely ridiculous. You know what I mean? It's a super clean trade, failure to go higher. Does anybody, before I get into my rant and my ramble, at this point of the mentorship, I know this is the money trade. This is what we all love to trade. Is anybody still confused about how do I identify a failure to go higher? Does anybody need me to just walk it down, plain English? It's no hard feelings if you don't fully get it. I just want to make sure everybody fully understands. Let's see what the people say. Me, kinda. Can you walk it down 100%? Yeah, okay, absolutely. Don't worry about it. I'm happy you guys answer that. The main premise of the failure to go higher. The first thing that we need to look at is, did we sweep a high? And there's a failure to go lower too. It's the same thing, right? We're gonna use higher for this example because it's fresh in our mind and it's right in front of us. All the failure to go higher is a sweep of a higher time frame high. A lot of people will call it an HTF to be complicated. It's a sweep of a higher time frame high, right? When you dive into the 1 minute chart, because that's my specialty, that's what I focus on. When you dive into the 1 minute chart, this is our 4542 level. That was a higher time frame high. When we sweep this high and we start to push back down, my light bulb in my head goes off for me to start looking for shorts. The reason I'm looking for a short, and I explained this on Twitter Space too, is because at this moment in time, when we've pushed up so much, when every call option, out the money, in the money, at the money, all the call options at this point have run 100%, 200%, maybe 250%. We had a good rally in the morning. All we need to do as option traders is look for what's at a discount. It doesn't mean that, oh, we swept a higher time frame high, let me just go short. There's certain protocol and there's certain criteria that needs to be met before you enter a failure to go higher. You can identify it in real time. A lot of us are actually pretty good at that in the chat, that, oh, this is looking to be a failure to go higher. A lot of you guys are getting really good at that. What we need to look for, and let me clean up my chart. The only thing I'm going to leave up is this 4542 level. It's a very important level because it's a 15-minute higher time frame sweep of the highs. The main thing that we need to look for is, as soon as we have a trend change, a structure shift, whatever the case may be. And actually, let me get rid of this line because I need to actually explain it better. So, can everybody see this clearly? Should I zoom in a little bit more? Is this okay? Good. Okay, perfect. As soon as we have a trend change, which is any swing low that gets broken down with a displacement, which is basically right here. I'm extending the line a little bit farther. As soon as the market rolls back down and breaks this and kind of is looking the change in trend, the light bulb in my head goes off to, okay, I need to look for shorts. What's the criteria to look for a short? And I'm going to type this out after the lesson. I don't want to really distract from anything. The criteria for looking for a high quality reversal trade. First of all, what's the draw on liquidity? The draw on liquidity today, the main level to sweep before we look the other way, was 4542. The draw was a bullish draw. The draw was a buy side liquidity. The draw was a sweep of highs. Same thing, different way to say it. As soon as we sweep those highs, I'm looking for the market to roll over, make a trend change. Step one, what's the draw on liquidity? Step two, did we have a market structure shift? Did we have a trend change? Market structure shift is a fancy way of saying, did we change in trend yet? Okay. It could happen on the 1 minute, it could happen on the 5 minute, happen on the 15, etc., etc. I like to look at them on the 1 minute and use the 15-minute as my confluence for targets to trim at. But we'll get into that in 2 seconds. I don't want to overcomplicate it. Step two, market structure shift and a trend change with a displacement. The displacement here was so small. I'm actually going to try to zoom in as best as I can. That's a good way to put it. And let me try to find the arrow on this thing. Give me a second. I don't know where I think TradingView like moved where the arrow is at. Give me a sec. Oh, here it is. Okay. This guy right here, this candle right here, that small little displacement is what we should have been looking at that first. The first entry wasn't that great. The first entry came from this candle right here. That was the one where we sat there, we were in drawdown. I think it was a 30% trade. That was a dud. The first trade was a dud. I think I secured like 12 cents of profit. Nothing really crazy. As soon as we break trend and we have a structure shift, all the failure to go higher is okay, let's look to retrade into this displacement, look to go short. At this moment in time, too, the option contracts didn't have a gap. That's what made today's trade actually a little bit unique. But look to short inside this gap, right? The market is kind of ready to go. There's so many opportunities. We traded back up. This looks scary because we're pushing back up, close back in. These candles consolidate, consolidate, consolidate. Get yourself an entry in this displacement box with a good stop loss. After you do that, the next steps of this trade are to aim for old lows, swing lows essentially, right? So TP1 equal lows here, TP2 kind of equal lows here, right? Extendo TP3, extendo clip equal lows here, which we didn't really get and we got trailing stopped on. Low of day essentially, right? 930 open was right here, lines up with this kind of equal low here. On SPY, it was the 448 level. There's your whole rundown of the trade. I don't know if I did the best job tonight of explaining it. I could go into more detail if you want, but let's see. Where did you enter the start? Let me grab my cell phone. I'll tell you the exact time. Give me a sec. I'll tell you right now. Because I actually low-key forgot the time. I'll tell you right now. That was the 450 puts. Let's see. I started buying them at 1034 and I added a fat chunk at 1035. So let's see. 1034. This candle right here, and I added another huge batch right here. So our timing on the re-entry was low-key impeccable. I'm not gonna lie. That's not for any sort of reason. That was just me seeing how this gap was being super respected. So starter came at 1034 on this red candle. We had pushed up into this gap, failed to close above it. We didn't really overrun it that much. This candle started pushing down. I entered, closed back up, back into the gap, entered a little bit more, risking 12 to 13 cents on the trade. And then, 1-2 minutes later, it's smacking our TP. It's going crazy, right? So 1034 and 1035. That was the real quality trade. You know what I mean? The first trade, I'm not gonna lie with you guys, I went in with half size. The second trade, because I had just noticed this gap that developed. I don't know if you guys remember on mic, but I realized it a little bit late. I'm happy I did realize it. I had to zoom in a lot to see this. I'm not even kidding. I had to zoom in a lot to see this mini gap, and I saw the way it was getting respected and rejected so many times. I really had a good feeling about this trade. And I was really targeting on SPY. It was at 450.24 level. I was calling for it. Even when we pushed down here, I was like, we need to get down here. If the market was willing to roll, this TP was going to get smacked, right? TP2 with these equal lows, this candle that came in here was so quick and aggressive. It was like a shoot straight down. My alert went off and these contracts just flew. I think they flew straight to $1.80. I think it was like 2 minutes. It was fucking crazy. So this is the way. Oh, sorry. Give me 1 second. This is the way that I like to enter these trades. So, and that's a valid question. For full size, what I like to do nowadays, since I'm on mic and I want to use starters too. I don't want to really. I enjoy getting my full position in at one shot. That's really how I used to trade. Now that I want to be more accurate and like literally kind of just more peace of mind, I want to see. This is what I want to see. I want to see this displacement get left, right? I want to see us push up into this displacement. I want to see the first candle close into that fair value gap, right? As soon as this candle starts pushing back down, I look to enter, right? That would have been okay, and the stop loss is there, whatever. I look to enter my full size when we start pushing out of there. That's really where the full answer comes. That's like my extra level of confluence. That's what I like to wait for. You know what I mean? So it's like waiting that extra second. Like, okay, we pushed up into the gap. We closed into this gap. The moment we try to shoot out of there, I'll take it. Would just stop be at the top of the fair value gap. I don't trade futures. I trade monetary value on option contracts, right? So my stop was wherever it's going to be 13 or 14 cents away from my entry price on the contract chart. I don't know what that would correlate to on the actual chart, but yeah, the highs, that's what we got into, Da Vinci. It was these guys right here. These guys right here. Boom. 4542. I know I marked it like a quarter off. Yeah. Yeah, 13 to 15 cents. It's really not a lot of risk, to be honest with you guys. It's really not a lot of risk. I don't care how many contracts you're trading. It's not a lot of drawdown on an option contract. Like, bro, today's trade, I'm risking 13 cents. And for my entry price, the contracts went $1.20 above. It's, come on. You know what I mean? Like, that's the risk to reward ratio is fucking impeccable. You can't beat it. That's why if anybody's like scared of reversal, scared of this and that, you can't get this return on any other strategy, in my honest opinion. I don't care if you're a breakout trader, swing trader, buying the contracts near low of day. Like the low of day on these 450 puts that we took, and you can go check this for yourself. The low of day on these contracts that we took was 53 cents, and we're buying them at 65. That's pretty close to the cheapest price that they were for the whole entire day. And they never saw 65 after we got out of them. These contracts ran to $4.50. Obviously, I don't know who the fuck is calling me. Obviously, I didn't hold for that long, but it's insane. That's almost 800%. Right? That's the whole scary part. The whole scary part of trading is buying it when it's cheap. Nobody wants to buy stocks, and nobody wants to buy anything when it's cheap. People start to value things when it's expensive. It's human psychology. It's like weird. You guys need to start training your brain that, okay, the contracts are cheap right now. Let me look on the chart. Who can guess the opening price of these 450 puts that we traded today? And don't cheat, don't lie. Who can guess the opening price? What was the price that they opened up at in the morning? And I'll tell you guys. Jacob said 23 cents. You're out of your noggin, brother. No. They opened up at $240, $2.40. And we're buying them for 63. It's ridiculous. It's literally ridiculous. I don't know what percentage of a discount that is. That's more than 70% off sale. You know what I mean? If Louis Vuitton goes on 70% sale, everybody's going to max out their credit card tomorrow and wait in line. You know what I mean? But when it comes to option contracts, oh, it's scary. I should wait. No. You want to buy them when they're cheap. You want to have an edge. The edge is, okay, what's our edge? We took out a higher time frame high. Let me look for puts. What puts are reasonably priced? Okay, they're trading around 60 cents. They opened up at $2.40 1 hour ago. Our entry came at 10:34. The market opens at 9:30. At 9:30 a.m., somebody was buying them for $240 a pop. 1 hour in, we're buying them for 60 cents, $60, whatever you want to call it, $65. You want to get technical. Is that not a deal? Learn how to, you make your money on a buy. I swear to God, I don't care what you trade. I don't care if you trade watches, cars, real estate, whatever the case may be. You make your money when you buy something. You don't make your money when you sell something. Understand that. And if anybody wants to argue, I guarantee you you're wrong. You could come up here and argue, you're not going to win this one. You make your money on any distressed asset, option contract, watch, car, house, shoe, whatever the case may be, whatever item you want to purchase. You make your money when you buy it, not when you sell it. You buy it with the intention to flip it for a higher price, absolutely. If it goes against the wall, that's fine. Don't worry about that. But you were risking 13 cents to look for a dollar move, to look for 50 cents, 40 cents at least, right? Learn how to identify that. And I want everybody to start paying attention to that. Tomorrow, maybe we're going to trade calls, maybe we're going to trade puts. Whatever contract we trade, I want somebody to be like, oh, yo, these opened up at, $1.50. If we're trading a contract for 50 cents, I want you guys to start being aware of that. I am aware of that. Maybe I should be more vocal about it, but I'm just so used to it. They're trading at $240 an hour ago. We're buying them. We're stealing them. We're stealing them for 65 cents. Think about that. I don't know what the percentage discount that is, but in 1 hour, they lost that much value and they make more sense in 1 hour. That's why sometimes it makes sense for the 10 a.m. news. We'll wait. I would love to be finished with work 15 minutes in, but the good deals happen an hour in. The good deals happen later in the day, right? The good deals, like I'm looking for discounts all day. That's why I read premiums. I try to study premiums a lot. It's not even about being cheap. It's about being smart. If I can buy something that some other schmuck was paying $240 for, I can buy way more than them for the same monetary value. Think about that. Somebody that bought it for $240, you're buying a 60-cent contract. You need to buy, for every 4 contracts you have at 60 cents, they bought 1. You guys understand that? But you're trading the same product. You're trading the same contract. That's the whole point in options. That's how you leverage your money. The same person that bought it for $240, maybe imagine this. This is the scenario that made sense for me when I thought about it this way. Imagine you were bearish going into today. You had a lot of money. You had $1 million account. Who cares? Imagine you bought one contract for $240. You're going to hold it for the whole day. You bought one for $240. Somebody else came in and bought it for 60 cents. They used the same $240 that you did in the morning, but they have 4 of them. They had using the same amount to trade, same contract, but at the end of the day, they'll make $200 a contract by 4. And you'll make, when these contracts ended up at $4, $5, you're just going to make $260 on one contract. They're going to make $250, $240 on 4 contracts using the same amount of money that you used to trade that one contract. Does that confuse anybody? Does that make sense to anybody? That's the whole psychology and point of trading. That's the whole idea, right? Look for those deals. Don't be scared to jump in when it looks like a good deal. There's a lot of fear that goes on when we're trading reversals because the contracts look cheap. The volume hasn't poured into them. If anybody wants to go on the contract chart on the 450 puts, and you guys should be doing this, look at the amount of volume. Look at the amount of people that started buying right after we got in. And this is not a pump thing. This is not about, we're not putting 5,000 in volume on these contracts. I don't care how many people are in this chat. We bought them at 1034. I'm looking at the contract chart right now. We bought them at 1034. That 1 minute volume candle had 516 in volume. I was probably a fifth of that when I added, right? 2 minutes later, 3 minutes later, 5,000 in volume in this 1 minute candle. 1 minute later, 3,000 in volume. 1 minute later, another 3,000 in volume. When they get expensive, when they touch $1.80, 5,000 in volume. That's when everybody wants it. When we're buying it though, fucking nobody wants it. Think about how many participants are in the market. One minute candlestick at 1034 had 500 in volume. And I was 100 of those. Nobody wanted them when I liked them. But they love them at $1.73. When we're selling it to these morons, which they ended up being right later in the day, but we're already up 200%. We didn't get that $4, so it's hurting me to look at this contract. But everybody likes it when it's going in your favor. You know what I mean? That's when people, let's hop in now. Trend is your friend. We're getting in right when the trend is finally starting to roll over. It looks crazy. It feels scary. Who can agree with that? That trading reversal sometimes it feels a little scary. It feels a little. I'm not gonna lie. When I first started trading like this, I was sweating. It feels very scary because everything you're taught, trend is your friend. Don't counter trend trade. We make so much bread, free bands, counter trend trading. You know what I mean? Like I love this shit with all my heart. I love counter trend trading so much. Don't be scared to execute. If you're getting scared to execute, back test a little bit. Look at the bigger time frames. When you identify it on the bigger time frames, start diving in deeper, deeper, deeper. 5 minute, 1 minute, whatever the case may be. But start on the 15 minute. Look for the old highs, look for the old lows. Align that with the contract chart. You know what I mean? Sen, you're trading futures. I know it's a little bit different. Same game though. Honestly, same game. You don't have to worry about fill price that much, theta, uh, whatever the case may be. IV, all this shit, right? It's just like extra fuel in the fire for option traders. But it's fun. So when it goes in your favor, it's the most fun ever. 11, 12 minutes to make 200%. I'll take that every single day of the week. And we usually do take that most days of the week with a failure to go higher, right? So that's the whole ideology of trading reversals, right? I don't want to overcomplicate it. I'm not going to make it seem like it's something so brand new and different. It's just that you can be very precise when you trade like this. You don't need to risk a lot, and the upside is massive, right? Focus on the opening print of where did these contracts open up. 30 minutes ago, they were trading at this price. Now they're trading here. Start putting the puzzle pieces together. Excuse me, I forgot I speak English. Start putting that together. It's a little game. The market gives you little hints. You need to put it together. You need to be a quick thinker sometimes. Think practically, but also be a little bit of a quick thinker. Okay, these contracts opened up at $2. I'm buying them at 60 cents. Do they have the potential to run back to $2? Yes. You know what I mean? Absolutely. Absolutely, they do. We're going to do, honestly, on Sunday, hold me to this. If I'm not going crazy on Sunday, we're going to do more back testing on demand, and we're going to watch how premiums move only. We're not going to really worry too much about the stock, about SPY chart. Let's start fully understanding premiums. And if you guys have noticed throughout this whole mentorship, I never talk about Greeks. And I do that deliberately. I do that intentionally. I'm not here to talk about Vega, Gamma, blah, blah, blah. Big words. Big words. We're avoiding that. Keep it simple. Focus only on premiums. Focus on how can they get back to their old highs. How can they run? How can I buy them when they're cheap? How can I not risk a lot? How can I trim at the right spots? Just keep your trading systematic. You put your take profits as an alert on Thinkorswim. They hit your alert, you trim some. It's automatic. You just wait for it. You just wait for it. That's it. Sometimes I break my own rules and I trim a little bit early to be safe, but today I did that for TP1 and I was like a minute early because I was just getting a little antsy. That's something that I wrote in my journal too. If I had just waited one more minute, I could have capitalized on another 10 cents on my first take profit. It's another $1,000. It's another $500 at least, right, in my pocket. I just a little bit impatient. You know what I mean? So let's keep focusing on that. That's the basic rundown of a failure to go higher. There's not much more that goes into it. You know what I mean? There's not much more that goes into it, right? We've taken cheap ass contracts and sold them expensive, right? Those are like the lotto plays, the crazy ones. You need a crazy move to get it, but we've hit those before 600%, 1000%, 700, whatever the case may be. You're buying them for like $8 a contract. Some days they'll run to a dollar flat. You know what I mean? It's just ridiculous. Those happen few and far in between. The consistent way is to go a dollar out the money and just run it back up. You know what I mean? So, Andrew, at this point, you can clip the lesson. I just wanted to have like an open discussion with you guys, see where everybody's head's at.